Welcome to the Yellow Cake investor presentation. My name is Andre Liebenberg and I am the CEO of Yellow Cake. I'll turn quickly to the disclaimer slide. It is an important part of our presentation. Well, let me talk a bit about Yellow Cake and why it was established. Yellow Cake is essentially a physically backed ETF in a corporate vehicle. Yellow Cake holds physical barrels of uranium. It doesn't have any mining operations, so therefore doesn't have any of the operating risks associated with geology, mining, processing, and marketing. Yellow Cake was set up in a low-cost structure. We've outsourced most of our activities in terms of the accounting, bookkeeping, in order to keep our cost structure as low as possible, to ensure that the drag on the entity is as small as possible. A key feature of Yellow Cake, and something I'll cover in a little more detail in the next slide, is that we have access to a contract which allows us to purchase up to $100 million worth of uranium per annum at the spot price. So being an investment, being a physical holding company, it's important to have access to material and have access at the spot price. Let me just talk a little bit about the backdrop, or the industry backdrop, which supports our belief in the future of uranium and the future rise in the price of uranium. Uranium has a steady and growing demand future. If you look at the build of nuclear reactors, which is the principal use of the uranium that we hold, these nuclear facilities take a long time to build, a long time to permit. So the build profile is pretty visible, and the World Nuclear Association forecasts that demand growth will be something like 2% through to the mid-2030s. The issue or the thesis that we've built Yellow Cake around is that the supply side risk is much greater than the demand side risk. If you look at the demand side, there are 441 operating reactors in over 30 countries, supplying about 10% of the world's electricity generation. However, on the supply side, we've got a much more concentrated structure. There are only a handful of companies which produce 2/3 to 3/4 of the world's uranium, and located in principally 3 or 4 geographies. We have seen a long period of sustained low prices, which recently has started to lead to supply cuts, but also the long period of low prices has meant that very little investment has gone into future supply, which would be needed. We saw earlier this year the impact of COVID on the very concentrated supply side, and at one point in time, around 40% of the world's production capacity was impacted through COVID. Just briefly, the key contracts that we have. I mentioned the supply contract. This is a strategic advantage that we have. We have a 10-year framework agreement with Kazatomprom, which is the world's largest and lowest cost producer of uranium. And that contract allows us to buy up to $100 million of uranium each year through to 2027. The contract allows us to purchase uranium at the spot price and at our option. So we can do all of it or none of it, or in multiple tranches. Our uranium is stored principally in 2 locations. There are 3 regulated storage facilities in the West, one in the US, one in France, one in Canada. We hold most of our uranium at the Cameco facility, which is just outside of Toronto. We also have a second storage contract with Urano in France, and this has allowed us to take advantage of price differentials between the 2 locations and then enter into location swaps for value. The final contract that's worth mentioning is we have a contract with 308 Services, which really manages the transactional activities of uranium in terms of the storage contracts and the contract with Kazatomprom. Briefly on the history of Yellow Cake, we IPO'd in 2018, raised $200 million. We purchased 8.1 million pounds of uranium. In August of that year, we purchased a little bit more uranium. April last year, we raised $34 million and purchased $30 million worth of uranium. In January of this year, when our share price was trading at a significant discount to net asset value, we launched a small buyback. And in July, we sold 300,000 pounds of uranium, which is about 3% of our holding, and bought back and turned that into a $10 million share buyback program. We currently hold 9.2 million pounds of uranium in the two facilities that I previously mentioned. If we just look briefly at the industry context, as I mentioned, 441 operating reactors. The US has the biggest reactor fleet, 95 operating reactors, which consume about 45 million pounds of uranium. If you look at the broader Europe, it consumes about the same amount of uranium as the US does. And China, which I will cover in the next slide, consumes about 20 million pounds of uranium today through 48 operating reactors. But the real growth in this industry will take place in China, India, and the Middle East. At the moment, China has 48 operating reactors, 12 under construction, and another 44 planned. They are planning to build between 6 and 8 reactors a year, which will mean that by the mid-2030s, they will treble the size of their fleet. The other big area of interest is India, and then the Middle East. The UAE has a 4-reactor program. 1 has just been completed and connected to the grid, and another 3 are under construction. On the supply side, if you look at today's spot price of just below $29 a pound, about half the industry does not make money at that spot price. And the reason these mines are still in operation is that historically the mines have contracted long-term with utilities, and this is typical in the industry. Utilities typically buy between 80 and 85% of their material under long-term contracts, and these are fixed price contracts or prices certainly set way above the current spot price. As these contracts roll off, the prices will have to be renegotiated, and they simply cannot sustain, the current operations cannot sustain themselves at the current spot price. And this led to significant supply cuts starting to take place from around 2016. In 2016, Kazatomprom announced plans to cut production, and then in 2017, Cameco did the same when they suspended the operations at McArthur River. Those supply cuts continued into 2018, and we see that significant impact of COVID in 2020. So where in 2016, about 160 million pounds of uranium were produced, in 2020, we think that will probably be around 120 million pounds. The underinvestment in future supply because of the sustained period of low prices that I mentioned is showing up as a growing supply deficit into the future. And the only way this will be addressed is that prices need to rise to attract new supply into the market. I mentioned the long-term contracts that utilities utilize to purchase their uranium, and you can see here the forward coverage of contracts in the US and in Europe, and in particular in the US from about 2022, we see a rapid decline in the contract coverage rates. So those utilities do need to come out and start contracting to replace those forward contracts. So just in summary, Yellow Cake provides pure exposure to the uranium price. We don't have any operating risks. The company has a low-cost structure, and we have an ability to grow through the contract we have with Kazatomprom. The uranium price has performed strongly this year on the back of COVID, and we continue to believe that the supply side has more risks than the demand side. We do expect that the utilities will come back into the contract market, as you could have seen from the previous slide, the coverage rates do fall off quite dramatically. Thank you for your time.